On June 25, 2026, just 1 week ago, Fortune published a headline that cuts through all the noise about America's national debt. The headline was this: "The bond market knows something about the $39 trillion national debt that Washington doesn't." The article's core finding was simultaneously reassuring and alarming. There is no immediate debt crisis, but the trajectory is genuinely dangerous. And the bond market, the $28 trillion market where governments, institutions, and investors trade U.S. Treasury securities, is quietly sending signals that Washington is not reading carefully enough. Let me give you the actual numbers first. The U.S. national debt hit $39.2 trillion in June 2026. Annual budget deficits are projected to rise from $1 trillion in 2026 to $3.1 trillion by 2036. The Congressional Budget Office projects debt held by the public will rise from under 1% of GDP in 2026 to 120% by 2036. The One Big Beautiful Bill Act, passed in 2025, is estimated by the CBO to add $3.4 trillion to federal debt by 2034, even after accounting for increased tariff revenue. Interest payments on the national debt are now the fastest growing line item in the federal budget, already exceeding defense spending in total annual cost. And the 10-year Treasury yield stands at 4.48% as of June 17th, near the top of the range that has defined the past year, while Japan's government bond yields are rising, making U.S. Treasuries less uniquely attractive to the world's largest foreign holder of U.S. debt. 3 of the most respected financial voices in America are warning about this, from 3 different directions. Jamie Dimon, CEO of JP Morgan Chase, the world's largest bank by market cap, said in April 2026, quote, "There will be a bond crisis, and then we'll have to deal with it." He said it matter-of-factly, not as a doom prediction, as a historical inevitability. Ray Dalio, founder of Bridgewater, the world's largest hedge fund, sees the problem manifesting first in public spending. He argues that interest payments on the debt will crowd out every other government priority: defense, social security, healthcare, infrastructure, until something breaks. Henry Paulson, former Treasury Secretary, warned in April 2026 that a collapse in bond demand could trigger a, quote, "vicious fiscal crisis." Today I'm telling the full story of the U.S. national debt, the real numbers. What the 3 scenarios are: bond crisis, spending squeeze, or financial repression. Why the bond market is the early warning system most people ignore. And what the most important empirical study of financial crisis ever conducted tells us about where America sits on the historical timeline. I'm pairing this with Carmen Reinhart and Kenneth Rogoff's landmark book. This time is different. 8 Centuries of Financial Folly, the book that analyzed 800 years of financial crisis across 66 countries and found one consistent, devastating pattern. Welcome to Earnings Per Page. Honest finance, no hype. Hit subscribe. Let's get into it. Part 1. What the debt actually means. Let me establish something important before going further. National debt is not the same as household debt. It doesn't work the same way. Countries don't go bankrupt the way people do. The U.S. retains what economists call the exorbitant privilege. The fact that the U.S. dollar is the world's reserve currency means that global demand for dollars, and for dollar-denominated assets like Treasury bonds, provides a structural advantage no other country has. This is real and important. It's why Japan's debt, which already exceeds 200% of GDP, hasn't triggered a financial crisis. Japan's debt is overwhelmingly held by domestic investors who don't sell under pressure. The US has similar, though less extreme, advantages. There is genuinely no magic number where the debt automatically becomes unsustainable. The debt will be sustained, as one economist told Fortune this week, as long as there are lenders willing to sustain it. And so far, there have been. This is the honest starting point, not doom, not dismissal. The debt is not an immediate crisis. The trajectory is dangerous. These are both true simultaneously. Part 2. The 3 scenarios, and which one is most likely. Here's where the voices of Dimon, Dalio, and Paulson diverge, not on whether there's a problem, but on how it manifests. Scenario 1, Dimon's bond crisis. Dimon expects a market reckoning where bond investors begin to demand higher yields because they view U.S. Treasury securities as a riskier borrower as the debt pile grows. This is the sudden, visible crisis scenario. Yields spike. Borrowing costs rise sharply across the entire economy. Mortgage rates, auto loans, business loans, everything gets more expensive simultaneously. Stock valuations fall because higher bond yields make equities relatively less attractive. It's the scenario most people imagine when they hear debt crisis. The honest assessment? This is possible but probably not imminent. The 10-year yield is at 4.48%, elevated but not spiking. Bond auctions have been showing weaker demand. The Treasury Department has seen a string of weaker bond auctions lately, with tepid demand forcing yields slightly higher. But this hasn't yet become a sustained upward spiral. The early warning signs are present. The crisis itself is not. Scenario 2, Dalio's spending squeeze. Dalio sees the problem manifesting more gradually. Interest payments are already the fastest growing item in the federal budget. As debt grows and interest rates stay elevated, a larger and larger share of federal revenue goes to simply paying interest on past borrowing, not to any productive program. This crowds out spending on Social Security, Medicare, infrastructure, defense, education, everything. The government slowly becomes incapable of doing anything except servicing its own debt. This is the slow suffocation scenario, less dramatic than a bond crisis, more insidious, and in many ways more consistent with where the data currently points. The CBO's projections show interest payments rising inexorably as a share of GDP. This scenario is already beginning. Scenario 3, financial repression. This is the scenario that Reinhart and Rogoff document most extensively in their historical work. Financial repression is when a government allows, or is forced to allow, inflation to remain above interest rates, so that the real value of the debt is gradually eroded. Effectively, the government pays back its debt in cheaper dollars. Savers and bondholders lose purchasing power. Debtors, including the government itself, benefit. This has happened before in U.S. history. After World War II, the U.S. ran significant deficits and used a combination of inflation and controlled interest rates to gradually reduce its debt burden from about 120% of GDP in 1946 to about 60% by the mid-1950s. It worked, but savers bore the cost. The risk in 2026 is that the Fed's commitment to fighting inflation makes deliberate financial repression difficult to execute. New Fed Chair Kevin Warsh, who held his first meeting on June 17, 2026, immediately reinforced the Fed's commitment to price stability. But if fiscal pressures become severe enough, the historical precedent suggests that inflation has often become the path of least resistance. Part 3. What Reinhart and Rogoff actually found. Carmen Reinhart and Kenneth Rogoff published This Time is Different in 2009, immediately after the global financial crisis, drawing on data from 800 years of crisis across 66 countries. Their central finding can be summarized in one sentence. In the run-up to every major financial crisis in recorded history, the people most affected believed, sincerely, that their situation was different from historical precedent. They believed their debt was manageable. They believed their institutions were uniquely resilient. They believed this time was different. It never was. Their data showed 4 consistent patterns that preceded debt crises across all countries and all eras. First, debt rises as a share of GDP over an extended period. The US has been on this trajectory since the 1980s. Second, external borrowers, foreign investors, come to hold a larger share of the debt. Historically, when foreign holders start reducing their treasury exposure, it's a leading indicator of stress. Japan, the largest foreign holder at roughly $1 trillion, has been increasingly looking at its own rising domestic bond yields as an alternative. This is a signal worth watching. Third, there is a period of complacency where analysts and policymakers consistently underestimate the risk. The Fortune article from this week quotes an economist saying there's no magic number where debt becomes unsustainable, and it will be sustained as long as there are lenders willing to sustain it. This is true. It's also exactly the kind of statement that preceded every historical debt crisis in Reinhart and Rogoff's dataset. Fourth, the crisis, when it comes faster than expected. The tipping point is impossible to predict from the outside. What looks like sustainable trajectory can shift quickly when a sufficient number of large investors change their behavior simultaneously. The Japanese repatriation of capital, moving money home into Japanese sovereign bonds as Japanese yields rise, is worth watching specifically because Japan holds $1 trillion of treasuries and is showing early signs of treating domestic bonds as more attractive. Part 4. The bond market as the honest scorekeeper. Here's why the bond market specifically matters more than most other economic indicators for this story. The bond market is the largest financial market in the world, roughly $133 trillion globally. It is dominated by institutional investors, pension funds, sovereign wealth funds, insurance companies, foreign central banks, who are doing large-scale, long-term risk analysis. They don't have political reasons to be optimistic. They don't have reasons to pander. They hold what the math tells them to hold. When Treasury bond auctions show weaker demand, it means the institutions that know the most about sovereign credit risk are quietly demanding higher compensation for holding US debt. It doesn't mean crisis. It means they're paying attention. The 10-year Treasury yield is the single most important number in the US economy. Every mortgage rate, every business loan, every bond issuance, every stock valuation calculation ultimately traces back to the 10-year yield as its reference point. If that yield rises significantly, say to 6 or 7%, the cost of everything in the economy rises simultaneously. That's why Dimon and Paulson are watching bond auctions carefully, because the bond market is the only scoreboard that can't be revised. Part 5. The One Big Beautiful Bill Problem. Here's the most important specific risk for 2026 and beyond. The One Big Beautiful Bill Act, signed in 2025, is estimated by the CBO to increase the national debt by $3.4 trillion by 2034. This is on top of existing deficit projections. For context, the entire COVID relief spending package in 2020 was approximately $2.2 trillion. The OBBB Act adds more to the debt than the entire emergency pandemic response. At the same time, it reduced the income tax on Social Security benefits, which we covered in video 35, reducing revenue flowing into the Social Security Trust Fund, and it extended tax cuts that increased the deficit. The combination, higher spending, lower taxes, less revenue from entitlement income, is precisely the trajectory Reinhart and Rogoff documented as preceding fiscal stress. The CBO's own language is important here. The CBO estimates the OBBB Act adds $3 trillion to federal debt by 2034, quote, even after considering the partial offset from increased tariff revenue. The tariff revenue doesn't come close to covering the cost. Part 6. What this means for your money. Here's the honest, practical section. For individual investors in 2026, the national debt creates 3 specific financial risks you need to understand. First, inflation risk. If the government ultimately resolves its debt burden through financial repression, allowing inflation to run above interest rates, your purchasing power erodes unless your investments are inflation protected. Treasury inflation protected securities, or Type S, are one tool. Index funds that hold real assets, real estate investment trusts, commodity-linked funds are another. Second, interest rate risk. If bond yields rise, either from bond market pressure or from persistent inflation, the 60-40 portfolio that dominated retirement planning for decades is under structural stress. When bond yields rise, bond prices fall. A portfolio that assumed bonds would provide stability during equity downturns is vulnerable if both bonds and stocks fall simultaneously, which has been happening more frequently since 2021. Third, currency risk. If confidence in the dollar erodes gradually over years, holding 100% of your wealth in dollar-denominated assets is riskier than it appears. A modest allocation to international equities, gold, or other non-dollar assets provides genuine diversification against this specific risk. Final verdict on this time is different. Should you read it? Yes, especially if you've never thought seriously about how debt crises actually unfold historically. It's dense with data, it's not a beach read, but the central finding, that every debt crisis was preceded by sincere belief that the situation was uniquely sustainable, is one of the most important lessons in the history of finance. My rating, 9 out of 10. The empirical scope is unmatched. The writing is academic in places. But if you want to understand where America sits in the historical continuum of fiscal stress, this is the book. The honest bottom line for 2026. There is no immediate US debt crisis. There is a genuinely dangerous trajectory. The bond market is sending early warning signals. Weaker auction demand, rising yields, Japanese capital repatriation that Washington is not addressing with urgency. The window to manage this problem without crisis is still open. History suggests it won't stay open forever. If this changed how you see the national debt conversation, subscribe to Earnings Per Page. Next time, I'm covering the most important personal wealth building story of the second half of 2026, why gold just hit record highs, and what that tells us about everything we've covered in the last 35 videos. Drop a comment with whether you think the US will experience Dimon's bond crisis, Dalio's spending squeeze, or financial repression. See you in the next one.